Ladies and gentlemen, good day and welcome to Raymond Ltd Q4 FY24 earnings conference call hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Kundu from Antique Stock Broking Limited. Thank you and over to you, sir.
Thank you, Steve. On behalf of Antique Stock Broking, I would like to welcome all the participants in the Q4 FY24 conference call of Raymond Ltd. Today we have with us from senior management of Raymond, this is Mr. S.L. Pokarna, who is Director of Raymond Ltd, Mr. Amit Agarwal, Group CFO, Mr. Sunil Kataria, CEO of Lifestyle Business, Mr. Harmohan Thani, CEO of Realty Business, and Mr. Jatin Khanna, Head Corporate Development. Without taking further time, I would like to hand over the call to Mr. Amit. Over to you, Amit.
Thank you, Abhijit. Good afternoon, everyone. Thank you for joining us today for the earnings call to discuss the results of the fourth quarter of fiscal 2024. I hope you would have received a copy of our results presentation. I would like to urge you to go through this along with the disclaimer slides. Let me start with a brief overview of the market for the quarter. The quarter took off slowly as discretionary spending was low at the backdrop of inflationary pressures, resulting in toned-down impulse purchases by the consumers. The K-curve recovery persists with low-income households curtailing spending while there is an upsurge in consumption of high-income households. As March progressed, there was an uptick in sales due to pre-Eid shopping. The real estate market maintains an upward momentum driven by increasing residential demand with expectations for this trend to persist in the forthcoming quarters. Additionally, there is a rise in demand for affordable luxury residences along with strong interest from first-time home buyers. Now let me talk about the fourth quarter of fiscal 24 performance. Raymond continues its growth momentum with the 11th consecutive quarter of growth, reporting the record-breaking performance both in terms of core revenue and profitability. In the fourth quarter of 2024, Raymond reported its highest ever quarterly revenue of 2,688 crore, showcasing a 23% year-on-year growth over 2,192 crore and increased by 238 crore on quarter-on-quarter basis as compared to 2,450 crore reported in the third quarter of fiscal 24. The growth was driven by robust performance in our branded apparel, B2B shirting, along with outstanding performance in the real estate sector. I am delighted to share that we have also achieved the highest ever quarterly EBITDA of 516 crore in the fourth quarter of fiscal 24 with a record EBITDA margin of 19.2%. This marks a remarkable 36% year-on-year growth compared to 379 crore and an increase of 90 crore quarter-on-quarter from 426 crore in the third quarter of fiscal 24. This being landmark 99th year of fiscal 24, Raymond delivered its highest ever annual revenue of 9,286 crore and an EBITDA of 1,575 crore with a margin of 17%. Despite subdued consumer demand and challenging market conditions for the lifestyle business, Raymond's focused business approach across its operation led to robust growth in branded apparel, garmenting, as well as in the real estate segment, resulting in an impressive double-digit revenue growth of 11% in fiscal 24 as compared to previous year. The real estate segment delivered stellar performance throughout the year, securing a total booking value of 2,249 crores. The record-breaking revenue and EBITDA performance underscores Raymond's resilience, strategic vision, and unwavering commitment to excellence and paving the way for continued success in its centennial year and beyond. Overall, with the increased sales and cost optimization, the company has been able to report the annual profit after tax of 655 crore, excluding the 983 crore profit gained out of the FMCG business sale, making a 24% increase compared to 529 crore in the previous year. Including the FMCG benefit of sale, company reported the net profit of 1,638 crore. Just to remind, during the year, Raymond Group sold its FMCG business for 2,825 crores. The strong business performance culminated in reporting highest ever EPS of 98 rupees, excluding the profit on sale of FMCG business, as well as board has recommended highest ever dividend of 100% to reward our valued shareholders for their continued support and trust. The growth was led by business branded apparel, in which we successfully leveraged the core strength of the brand coupled with our wide distribution network across the country. Despite muted consumer demand and weak market conditions, our strategic focus on expanding our distribution reach, as we demonstrated by opening over 200 new stores during the fiscal 24 and focusing on premiumization as well as casualization, resulted in strong growth for our branded apparel segment, achieving a 20% growth compared to the previous year despite weaker retail industry. In the garmenting segment, we are in the process of expanding our garmenting capacity by about one-third to participate in China Plus One adopted by most of the global brands. Also, this capacity augmentation is in line with the Government of India's Make in India initiative. The engineering segment performed well with resilient demand in the domestic market, while export orders were impacted due to challenges in the global market, and our future growth is led by completion of acquisition of Mining Precision in March 24, which forays into sunrise sector, aerospace, defense, as well as EV components, positioning us for exciting opportunities and expansion in these high potential segments. In fiscal 24, Raymond initiated major corporate actions aimed at securing long-term growth and enhancing shareholder value. These efforts were in line with our goal of achieving a net debt-free status and simplifying the group structure for maximum efficiency. Key initiatives included selling of the FMCG business for 2,825 crore, demerging the lifestyle business to unlock shareholder value, and strategically acquiring the MPPL Mining Precision business. Moreover, achieving net debt-free status 2 years ahead of schedule highlights our commitment to financial prudence and sustainable growth model. Now let me discuss about the segmental performance for the fourth quarter of fiscal 24. The branded textile segment revenue was maintained at 920 crore, a 2% growth over 902 crore in the fourth quarter of fiscal 23, despite muted consumer demand and challenging market conditions. The quarter saw mixed trends with moderate consumer sentiment affecting sales in the first half, but an uptick was observed later in the quarter. The EBITDA margin remained broadly flat at 21.9%. Let me talk about the branded apparel segment, which showed a healthy sales growth of 23% to 409 crore as compared to 332 crore during the fourth quarter of the previous year. In a weak market condition, our stated strategy of enhancing our distribution reach and network, focus on premiumization coupled with casualization led to growth in the branded apparel business. The growth was witnessed across all channels and brands, with Park Avenue, Park, Raymond Ready to Wear, and Ethnics by Raymond leading the front and well supported by the Color Plus brand. The segment delivered EBITDA margin of 13.4% in the fourth quarter of fiscal 24 as compared to 15.8% in the previous year. The EBITDA margin stood lower as compared to previous year because of increased investments in branding and category creation for Ethnics by Raymond and other brands through additional spending on advertisement and marketing initiatives to invest behind these brands. We continue to strengthen our retail footprint as we opened 39 new stores during the quarter, as well taking the tally to 1,518 stores as on 31st March 2024, which are spread across 600 towns and cities in India, including 114 exclusive outlets for the Ethnics by Raymond brand. Now let me talk about the garmenting segment, where during the quarter our revenue was 280 crore which is lower compared to previous year due to ongoing Red Sea crisis and geopolitical issues. However, we continue to acquire new customers and enhance our presence in newer geographies. During the quarter, healthy EBITDA margin of 11.3%, a significant improvement from 6.6% compared to reported in the same quarter previous year, mainly due to better product mix and enhanced operational efficiencies. Now let me talk about the high-value cotton shirting segment, where the top line grew by 14% to 213 crores as compared to 187 crores in the previous year, led by demand for linen fabric offerings to our B2B customers in the domestic market. EBITDA margin for the quarter was marginally higher at 11.5% as compared to 10.4% in the previous year, mainly due to operational efficiency. Now about the engineering business, which is consolidated under JK Files and Engineering Limited on an aggregate basis, the sales stood at 234 crores in the fourth quarter, a 7% growth as compared to 219 crores in the fourth quarter of last fiscal. The growth was driven by increased demand for our auto components in the both domestic as well as export markets, particularly for flex plates, bearings and ring gears. However, the engineering consumable category continued to be impacted due to sluggishness in export market. During the quarter, the business reported an EBITDA margin at 15.8%, which is slightly higher mainly due to better product mix. As part of our growth strategy in the engineering sector, during the quarter, Raymond completed the business acquisition of Mini Precision Product Limited. With its strategic acquisition, Raymond Group forays into sunrise sectors of aerospace, defense, EV components business. We are streamlining our operations by consolidating business of JK Files, which does engineering consumables, Ring Plus auto components, Mini Precision auto components, aerospace and defense, and simultaneously through a composite scheme of arrangement, two new subsidiaries will be created, one which will focus on aerospace and defense, while the other would cater to the auto components and engineering consumable sector, each charting its unique path of growth with a primary objective of value creation. Raymond will hold 66.3% in both the new subsidiaries. The remaining shares will be held by the Mini family and the minority shareholders, which is 28.5% and 5.2% respectively. Just for the reminder that on a pro forma basis for fiscal 24, the consolidated revenue of the engineering business, including Mini Precision business, was around 1,800 crores and the consolidated EBITDA in the engineering group was 270 crores. Now let me talk about the real estate segment during the quarter. In February 24, we have launched our first JDA project outside of Thane land in Bandra, Mumbai, which has received an overwhelming response with approximately 62% of the launch inventory sold within 40 days. Overall, during the quarter, we have seen a robust booking momentum and made a total booking of 840 crores across our projects. The construction momentum across all 6 projects is progressing well, demonstrating our commitment to timely delivery and adherence to high quality standards. A comprehensive update on the construction status of our project is provided in our investor presentation. The real estate segment delivered stellar performance throughout the year, securing a total booking value of 2,249 crores. After the successful launch of our maiden project 10X Habitat, addressed by GS Season 1 and 10X Ida, during the year we have launched 2 new projects at Thane land, addressed by GS Season 2 and the Invictus by GS project. Currently, we have got 5 ongoing projects worth 9,000 crores on our Thane land, with a further potential to generate 16,000 crores, making a total potential revenue from Thane land of 25 to 27,000 crores of 100-acre Thane land over the next few years. Additionally, we have signed 2 new JDAs in Mahim and Sion, and with this put together, the revenue potential from the 3 JDA projects, including Bandra in MMR outside of our Thane land, will be in excess of 5,000 crores. Our Raymond Realty business, which offers affordable luxury apartments ranging from 1 to 4 BHK that caters to multiple segments of society, and our proven ability to execute the project at a faster pace, enabled the sales to increase by 134% to 677 crore in fourth quarter of fiscal 24 compared to 289 crore in the fourth quarter of fiscal 23 last year. The EBITDA margin of 25.2% for the quarter as compared to 24.3% in the same quarter last year. Now let me talk about the working capital and the cash flows. On the working capital front, with our continued focus on working efficient management of working capital, we have worked on an absolute term that our net working capital stood at 2,319 crore as at end of March 24. During the quarter, we have completed the acquisition of Miny Precision, resulting in an increase in additional working capital of 316 crore. Excluding the impact of Miny Precision acquisition, our net working capital days would have been 68 days, which is lower by 3 days on a quarter-quarter basis from 71 days in December 23. In fiscal year 2024, Raymond successfully completed the acquisition of MPPL. While the profit and loss statement of MPPL has not been consolidated into Raymond's financials, the balance sheet figures have been consolidated, offering a glimpse into the company combined entities financials. On the full year basis of fiscal 24, MPPL revenue was 935 crore and an EBITDA of 146 crore with an EBITDA margin of 15.6%. On the balance sheet, as reflected in Raymond's financial statements, the integration of MPPL's balance sheet has notably increased Raymond asset base, with cross-current assets amounting to 534 crore, comprising inventory valued at 251 crore, receivable at 199 crore, and other current assets totaling 84 crore, with a current liability of 217 crore. This results in MPPL net working capital of 316 crore. Further, the consolidation of many operations has significantly augmented Raymond's net block by 1,244 crore. Now let me talk about the consolidated debt position. Our total gross debt stood at 3,426 crore, which comprises of external gross debt of 1,726 crore and NCD issued by Raymond Ltd to Raymond Consumer Care Ltd of 1,700 crore. We continue to maintain liquidity with cash and cash equivalent of 1,758 crore as on 31st of March 2024, and our net debt stood at 1,667 crore, higher by 749 crore versus December 23, mainly due to acquisition of MPPL business for 682 crore and taken over net debt of 286 crore of MPPL. Post demerger and acquisition of MPPL, the Raymond Group still holds a net cash surplus of 680 crore earmarked for growth capital. The interest cost in the quarter is 104 crore, which is higher by 40 crore as compared to 64 crore in the same quarter last year. The rise in interest cost can be attributed to several factors: an interest cost of 38 crore on the NCD issued to RCCL, which will be netted off upon the completion of the demerger, as the effective date is set for 1st April 2023. Interest of 5 crore for the deferment of approval cost payment to Mahada for Bandra project. Now let me provide an update on the demerger of the lifestyle business. The proposed demerger of the lifestyle business is progressing well as planned, having already received SEBI approval, SEBI shareholder and creditor approval. Further, NCLT hearing is scheduled on 9th May for the approval of demerger. Upon completion, this demerger will result into two distinct net debt-free listed entities, one focused on lifestyle business and the other on real estate and engineering. The first quarter began against a backdrop of cautious consumer sentiment marked by moderate discretionary spending and subdued consumer demand amidst inflationary pressure. The persistent K-curve trend reflects the ongoing dynamics of the market. We are actively participating and addressing challenges, including the constraint posed by limited wedding days in the first quarter and the impact of heat waves on the operation. Aligned with our guidance, we are on track to expand our retail footprint, and over the next 18 months, we plan to add almost 200 stores with the asset-light franchise model, led by increase in the store network for Ethnic by Raymond and all other apparel brands. In the real estate segment, in February 24, we launched our first JDA project in Bandra and following an enthusiastic response from customers, we subsequently introduced a new tower in the same Bandra project in late March. The positive reception underscores customer confidence in our high-quality offerings and the swift construction pace maintained throughout our project. Furthermore, we are currently in advanced discussion to finalize new JDAs, which we will come back to you. On an engineering segment, auto ancillary segment is witnessing good growth. However, engineering consumable business has been weak in the export markets. To conclude, I would like to reiterate that Raymond Group will continue to have three distinct vectors of profitable growth. We are fully geared up in terms of unlocking the full potential at each of these businesses. And with strong free cash flow and no major capex requirement, Raymond Group will maintain a net cash positive on a going forward basis. Now we will take questions from all of you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use the handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rohan from InCred. Please go ahead.
Yeah, hi sir. Congrats on a good set of numbers. I just want to check in the real estate division, we basically launched Raymond Vibes. So I just wanted to understand the current numbers that are there in the PPT. Is that specifically just for 10x Habitat?
Yeah, Harmon this side. So 10x Vibes is actually part of Habitat itself. It's a sub product over there. There is convenience shopping, which we have branded as Vibes. So it's a very small shopping area that we have, only 100 odd units, 0.04 million square foot. So currently it's fully sold out. So there is nothing that we have left.
Understood, sir. And will we be having a similar concept in the other projects as well?
Well, it differs from project to project and depending on the location. This project was on a 30-meter wide road and it had frontage on the road, so there was an opportunity to do some convenience retail. It also helps the project since this is the first project that we are delivering in the Thana land, so it's good to have convenience shopping for the residents as well. But it will be from project to project, we'll have to take this call.
Sure, sir. And just one question on the branded apparel side. How do we expect the margins to sort of pan out in FY25?
Yeah, hi, this is Sunil here. So as you've seen, we have been delivering margin in the range of around 12 to 14% overall post-Ind AS EBITDA. We have been very clearly focused on investing behind branded apparel. There are two areas which are happening. One is distribution through retail expansion and one is through advertising. So we will be continuing to invest behind advertising. Sorry, I don't know where the call got disconnected. But I'm saying, as I said, we will be focused in the coming year as well in behind both store expansion as well as brand building. And there will be a strong investment which will go behind investment on marketing. But despite that, I think we'll be focused on improving a gross margin as we're looking at a better margin in the current range itself.
Sure, sir. Just one follow-up. For ethnics, what have we ended the year at in terms of revenue? And if possible, can you give us a store count breakup across our brands, Park Avenue, Raymond, and the others?
Overall, in ethnics, we have mentioned that we have actually ended the 31st March at 114 stores. And that's almost close to doubling the number that we did in the last financial years. So overall, today we are at, including ethnics, we are at 409 stores, and which are broadly broken up across Park Avenue, Color Plus, and Raymond Ready to Wear and ethnic stores. We are targeting next year to add another 200 plus kind of stores across all our brands.
Sure, sir. Thank you.
In ethnics revenue, I would say right now it's too premature to give you a run rate on ethnics because this brand has a lot of seasonality. But I can tell you one thing, that the traction that we have seen on this brand in the second half of the year when the season came in is pretty much in line with the expectations that we set for ourselves.
All right, sir. Thank you. I'll get back in queue.
Thank you. The next question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi everyone, and thanks for taking my question. Just taking it forward from where the previous participant left. Some insights on the retail brand Ethnics. So you had 60 stores, around 60 stores at the start of the year, and if you can share, broad parameters of performance here, sales per store, store level EBITDA, working capital, debt stock, any major KRAs that you can share, and what are the plans for Ethnics specifically in FY25? How many stores are we targeting? Is it also going to be mostly franchisee driven, or it's going to be a mix of both? What is the current mix of franchisee plus, company operated? So the Ethnics part a little bit, sir.
So let me just take a shot at this. So actually our mix of stores and Ethnics would be skewed more towards the franchisee model. We'd like to operate in a range of around 25% company-owned stores, primarily for our marquee stores, because there are stores which come across in malls, there are stores which come on very, very prime, high street, which also serve as, marketing brand building stores as well. So when we see any such kind of properties, we'd like to obviously there are some very large stores that we want to do. So on those areas, we'd like to do a company-owned store. Otherwise, we'll do franchisee asset-light models. So that ratio would be broadly 25-75 kind of ratio. That's how we look at the mix. The current mix is also broadly in the similar range. In terms of store expansion, we are at 114 stores which we ended the year at. Would like to definitely look at crossing around 200 stores next year. If the markets remain good and they come back strongly in the second half, we could even look at expansion further beyond that. But yes, definitely we're targeting to cross 200 in the coming year. In terms of KRAs, as you all who track this market would know that this business has its own cyclical form, and we also see a lot of changes which happen along with wedding phenomena. So we have set certain KRAs which are linked to each season. Where we are in terms of each of this, I think in terms of the numbers that we set out for us, I would say we are close to around 80 to 90% in that range of the first season that we set out for us. And we are pretty much happy, given the fact that even though Q4 had wedding dates, it was still a muted and mixed wedding season which panned out, given that the brand had first year. But I think we have got a lot of things right in this brand. One, the product assortment is very, very appreciated by consumers. We got our pricing right. We got the store ambience right. We're getting it by and large in the right locations. So I think the mix is looking good, and we're just hoping for coming good wedding season to pan out second half of this year.
Sunil, I understand that there is a seasonality, but roughly the stores which started at the start of the year would have seen the whole season, right? The whole wedding season, one full wedding season. So any metrics on at least sales per store or margins or working capital that you can share would be helpful.
See, on sales per square foot, I would say there are certain parameters that we set out for us. I wouldn't be able to give you a number right now in terms of where we're tracking, but yeah, the goal, if I set it at 100, I would say that we have achieved around 80 to 90% in that range.
Got it, Sunil.
But I'll tell you what, because I would like to still see a full season, because if you see the store which I set out around 12 months back also, the first half of last year was again pretty much non-wedding in season. So what we have really seen is around 5 months of wedding season in this year. So for me to really put together finger saying, okay, has this store seen a full 2 cycles of wedding season? I don't think so. I can really comment on that right now, because not a single store has seen, let's say, 2 full wedding seasons.
Got it. Fair enough. I'll come back in the future.
It will be very premature for me to give you any number of any kind right now. It may lead to a different interpretation. But yes, I can tell you that yes, the number we thought we would, despite a very, very mixed bag of wedding season, especially in the JFM period, I think we're pretty satisfied with what we've been able to do, and we're in the 80 to 90% range of that.
Got it. And this full cycle, 2 cycles, you would expect to be done by end of FY25 only. Am I right?
End of FY25, because again, if you see in the first half of this year, it's going to be a very different kind of a season, that there are no weddings in the first full half this year. I mean, we've seen a very short wedding season of a week or so, or 10 days or so in April, and then actually there's no weddings at all till November,